why debt is a bad idea for real estate beginners and experienced investors. And it's not what you actually think. Today I'm going to show you why debt is a bad idea for you as a real estate investor. It doesn't matter if you're a beginner or an experienced investor, debt will ultimately kill your business if you're not careful. Back in 1991, I lost a $17 million real estate business because of some stupid mistakes involving debt. And I don't want you to make the same mistake. Okay, so let's look at debt and investing, the pros and cons. If you buy a $100,000 property, put $10,000 down on it, you get the purchasing value of $100,000 with only $10,000. But if you don't know what you're doing and you buy it incorrectly with negative cash flow, you have a risk of losing that property and screwing up your credit and losing your $10,000. Now, if you have the entire $100,000 to put down, it's a lot less likely that you're going to lose that property unless you fail to pay your taxes. So it's not as big a risk. But it's a lot harder to come up with $100,000 than it is to come up with $10,000. What I advocate for my mentor student is a zero-down investing strategy using seller financing instead of bank loans. So instead of going out and putting 10% down on a property and getting a bank loan for $90,000, you buy a property subject to and put nothing down on the property. In 2023, this is probably the best way to acquire properties given the prices and interest rates of today. You're going to sell that property on the same day that you buy it to a lease option buyer who's going to give you $10,000. So when you close, instead of coming to closing with $10,000 out of your pocket, you're going to get $10,000 from the buyer. And you're going to do it on the same day, so you'll never have any real risk, at least until it goes vacant. But actually, when that happens, that's a good thing too, because it's another profit center. We'll talk about that in a minute. If you've set that $10,000 that you got from your buyer aside for a rainy day, you'll be able to make the payments on it if the buyer fails to make their payments, and you'll be able to do any repairs that are necessary. You'll also be able to keep the cash flow on that property because hopefully you're going to have bought a property with some cash flow built in. Your monthly payments, your taxes, insurance, principal, and interest, and your property management are all going to be covered by the income that comes in on that property. Understanding negative cash flow. You always want to know your potential for negative cash flow. Negative cash flow will eat you alive. It's absolutely the worst thing that can happen in your business. Don't allow negative cash flow on your properties. It may seem small to start with, but it's a business killer. If you find that you've bought a property and you accidentally got negative cash flow, get rid of that property as quickly as you can, or find other ways to alleviate the negative, other sources of income. Don't get eaten alive by negative cash flow. You really have to pay attention to negative cash flow. I know I sound like I'm beating a dead horse here, but because even a few $100s on multiple properties can significantly diminish your profits. You also have to think about vacancies. In 2008, every investor I knew was losing their portfolio because of negative cash flow. I had a big portfolio at the time. It's bigger now. Mostly positive cash flow. But I had a lot of subject twos. And suddenly my vacancy rate went from 3% to 20%, which is substantial when you're making a whole, the whole payment for those properties. So I was really concerned about negative cash flow because the rest of the portfolio was just barely covering those costs. And I'm talking about my portfolio that's outside my Roth. I've talked about inside and outside the Roth before, and I won't get into that right now. But the part that was outside the Roth had negative cash flow when all those tenants stopped paying. I wanted to make sure that didn't happen for very long. I was able to get those properties refilled pretty quickly, and I had enough reserve to cover those costs. But if you have too much debt and you don't have enough cash reserves, you're not going to be able to cover vacancies and repairs when they crop up. You also need to worry about values dropping. Now, I had values dropping during 2008, but it wasn't as dramatic as other parts of the country. I wasn't in California. The market that I was in dropped 10 to 20%, but not much more than that. But the thing is, it stayed pretty stable with the rents. They dropped a little bit, but maybe 5%. So I didn't see much reduction in rents other than the vacancies that happened immediately during that first year or so. But the values kept solid. So because I bought properties that could support themselves with rent, I didn't have to worry about negative cash flow or worry about losing those properties. Back in 1991, when I was building new construction and I didn't have any income on those properties, as soon as the values dropped, there wasn't any way that I could make payments. I was using construction loans, so I wasn't actually making payments. They were built into the loan. But what the lender wanted was for me to come up with more money because the values dropped. They wanted me to have more skin in the game so they would be less exposed. But I was so leveraged at the time, I couldn't make that happen. I just didn't have the reserves. They took my properties from me. Leverage, that's the problem with working with banks. Leverage is a two-edged sword. It can be wonderful and make your portfolio grow. It can also eat you alive. You have to balance it and make sure you've always got enough cash flow. And I wouldn't buy a property that's just break even if I don't have another source of income to cover those costs. If I don't have any way to make sure those payments will be made and that property will be repaired and taken care of and refilled and continue to work properly for me. Now, if I buy subject to and the loan is not in my name, I don't have any money down on the property, I haven't put any money into the property to fix it up, and I put a lease option tenant in that property, I can be a little bit more flexible on those types of deals. In that scenario, I have to make a payment and I want to make sure I have a reserve to cover that payment, but I'm going to get lease option fees. And that lease option fee is going to go into a bank account. I'm going to save that lease option fee, or at least a portion of it, to make sure that I have enough to cover a month or 2 or 3, plus maybe some repairs if that property goes vacant again and I have to start making payments on it. The worst thing that could happen in this situation is the tenant stops paying. Maybe another pandemic comes along. Maybe another moratorium on evictions happens and you have to make the payments yourself. For a small business person, a small landlord who's only got a few properties, if they have 1 or 2 people who stop paying, it could eat them up. It's going to send them into bankruptcy and foreclosure. So be careful when you buy properties like this and think about the things that could go wrong in a deal. So there are a few things that can create negative cash flow. Vacancies, your values could drop, balloon payments can come due that you can't afford, vandalism or other repairs, insurance and taxes go up over time. Most areas also have higher property taxes for landlords than homeowners. So if you buy a property subject to from an owner-occupant, the taxes can easily double. This can cost you hundreds of dollars per month and seriously eat into your cash flow. And even if you plan on keeping your properties for the long term, which you absolutely should, your taxes are going to go up on a regular basis. Taxing authorities reassess your properties annually, and they'll raise your taxes every year. So what may have started as positive cash flow may be negative cash flow in a couple of short years. You also have to worry about economies crashing. We're in a volatile time, and the economy could take a hit. I think we're going to see another real estate crash here in the next year or 2, and we're going to see values drop. So make sure the income you have on your properties is enough to make the payments on your mortgages. I kept reserves with my properties, so when the last crash hit in 2008, I was safe. But I saw a lot of my investor friends lose their shirt because they didn't have enough reserves. We also need to worry about climate change. Weather is out of control. Some areas are worse than others. Just last week, we were at a restaurant and it started hailing. Hail the size of my fist was coming down. And that kind of hail does a lot of damage to a Land Rover. It broke my windshield and put so many dents in the roof that it's going to take weeks and weeks of going to the shop and getting it taken care of. Of course, I've got insurance. It's going to cover it. So it's not the end of the world. But hail hit my houses too. Insurance doesn't always cover the damage, especially with flooding. And insurance companies aren't going to be able to handle all the claims that are happening. I'm not trying to scare you away from owning properties. These are all acceptable expenses for you as an investor. The longer you're in this business, the more you're going to understand where those surprises are going to come from. And you're going to be able to set yourself up with reserves and cash flow and be able to handle those problems. My suggestion is, when you're just getting started as a real estate investor, you start by flipping properties using the for rent method. That means getting control of a property, turning it around and selling it, making a chunk of money. You're in and out of the deal without using your cash or your credit or bank loans. You don't have to worry about keeping it. You don't have to worry about cash flow. All you have to worry about is depositing that money into your bank account. That's a good way to start in this business. You learn how to put deals together. You learn what kind of deal makes sense. You learn how much profit you need in a deal to make it worthwhile. You learn how to negotiate bigger down payments, more rent. You learn how to take care of your properties, how to manage them. You learn how to get good tenants. And you can build all this in a few short months, not years. Building a profitable business using these techniques can happen very quickly. Once you learn how to put together deals that make sense, then you can start building a long-term portfolio. And that is what makes you wealthy. What to do next? If you're interested in investing in real estate without having to take on massive amounts of debt, check out my mentor program, the Zero Down Investing Accelerator. This is a 6-month mentor program where I walk you through step by step how you can purchase properties without debt using creative zero down strategies. My mentor program might be for you if you're an existing investor doing less than 5 deals a month and you haven't found a way to predictably scale your business. Or you're busting your butt doing a few deals a year, but you want more consistency in your income and you want to systematize, automate, and grow your business while you gradually extract yourself from the day-to-day work. Or you're completely new to real estate, never done your first deal, and are looking for a way to get started. Maybe you're looking to replace your current income entirely, quit your job, and create financial freedom. If you're not yet a member of my mentor program, here's a link for you to book a call and talk to us about it. My name is Joe Crump, and I've been a real estate investor and mentor for close to 40 years. When I started, I built a $17 million real estate business in 3 years, starting from scratch. In 1991, I lost it all because of wishful thinking and stupid but common mistakes. Unfortunately, I still see investors make those same mistakes every day. That's when I developed the pillars of the Zero Down Investing framework that I teach and use every day. Over the years, I've trained hundreds of people in my techniques and led them to real estate success. If you'd like to learn more about how to acquire real estate without debt, book a call with us here. You might also want to take a look at this income earnings disclaimer. It's required by the FTC and explains how it's important to pay attention to your deals.